In the winter of 1910, something unusual happened that almost no one noticed. No headlines, no public debate, no official announcement. Yet the consequences of what occurred during those days still shape every dollar you earn, save, or spend today. 7 powerful men quietly boarded a private rail car late at night in New Jersey. They traveled south under instructions not to speak to the press, not to bring staff, and not to use their last names. To the outside world, it looked like nothing more than a wealthy hunting trip. In reality, it was one of the most influential financial meetings in modern history. Over the next several days, at an isolated resort off the coast of Georgia, these men drafted the framework for a new American banking system. Not in Congress, not in public hearings, not with voters watching, in private. And when that system became law 3 years later, it fundamentally changed how money is created in the United States. To understand why this meeting mattered, you have to start with fear. At the beginning of the 20th century, America's financial system was fragile. Banks were loosely regulated, money supplies fluctuated sharply, and economic shocks could ripple across the country with alarming speed. When panic struck, there was no central authority to stabilize the system. That weakness was exposed dramatically in 1907. In the fall of that year, a series of failed financial schemes triggered widespread panic. Stock prices collapsed. Depositors rushed banks demanding cash. Institutions that had seemed stable suddenly failed. Credit froze. Businesses shut down. Workers lost jobs. Within weeks, the country was staring at economic breakdown. There was no central bank to step in. Instead, one man filled the vacuum. J.P. Morgan, the most powerful financier in the country, summoned bankers to his private library. He organized emergency loans, forced competitors to cooperate, and personally decided which institutions would survive and which would not. The crisis ended, but the message was unmistakable. The financial system had been saved, not by elected officials, but by private capital. In Washington, lawmakers drew their own conclusion. The United States needed a permanent solution to financial panics. In response, Congress created a commission to study banking systems around the world and recommend reforms. That commission would become the doorway through which private financial interests shaped public policy. The group was led by Senator Nelson Aldrich, one of the most influential figures in Washington. Aldrich had deep connections to banking, industry, and political power. Through business ties and family relationships, he was closely linked to some of the wealthiest interests in the country. Officially, the commission's job was to research. Unofficially, it provided cover. In November 1910, Aldrich and a small group of bankers agreed to meet far from Washington. The location was a private island resort in Georgia, accessible only to members. The journey itself was designed to avoid attention. Separate arrivals. No documentation. First names only. Why the secrecy? Because public opinion at the time was fiercely hostile to Wall Street. Any proposal openly written by major bankers would have been rejected instantly. The only way forward was invisibility. During that meeting, the group tackled a central problem: how to create a national banking system that could manage crises, without appearing to place power directly in the hands of Wall Street. The solution was architectural. Instead of a single central bank, they designed a network, multiple regional institutions, a governing board, a structure that appeared decentralized and public-minded, but in practice was tightly coordinated. The language mattered. The system wouldn't be called a central bank. It would use words that sounded official and reassuring. Federal Reserve, stability, balance. Ownership would be indirect. Member banks would supply capital. Directors would be selected through layered appointments. Government oversight would exist, but operational control would remain insulated from voters. It was a design that blended public authority with private influence. When the group left the island, they carried more than notes. They carried a blueprint. The path from blueprint to law wasn't immediate. Early attempts to introduce the proposal failed. Too many lawmakers recognized the fingerprints of Wall Street. So the strategy changed. After the 1912 election, political momentum shifted. New leadership came to Washington with promises of reform and modernization. Banking legislation was rewritten, rebranded, and reintroduced, this time framed as protection against future crises. By December 1913, the timing was perfect. Congress was preparing to adjourn for the holidays. Attendance was thin. Debate was brief. Few members had fully read the final bill. On December 23rd, it passed. That same day, it was signed into law. The Federal Reserve System officially came into existence. Within a year, it was operational. The effects were immediate and profound. For the first time, the The United States had a centralized authority capable of expanding or contracting the money supply. Interest rates could be influenced. Liquidity could be injected during crises. Government debt could be financed more easily. But this power came with consequences. Money was no longer constrained in the same way it had been under gold-linked systems. Credit expanded rapidly. Government borrowing became easier. Large financial institutions gained a safety net. Smaller competitors lacked. When war erupted in Europe, the new system made large-scale financing possible. Bonds were issued. Money was created. Banks earned interest. Industry expanded. After the war, cheap credit fueled speculation. Asset prices surged. Confidence soared. Then came the crash. The Great Depression revealed the system's asymmetries. While thousands of small banks failed, the largest institutions consolidated. Financial power became more concentrated, not less. Over the decades that followed, the pattern repeated. During wars, recessions, and emergencies, the system expanded. During recoveries, debts remained. The currency gradually lost purchasing power. Prices rose. Savings bought less. By the time the dollar was fully detached from gold in the 1970s, monetary limits largely disappeared. Crises became opportunities. In 2008, when the financial system faltered under its own risks, trillions were created to stabilize institutions deemed essential. Markets recovered quickly. Inequality widened. In 2020, during another global shock, the same tools were deployed at an unprecedented scale. Asset prices surged even as millions faced economic uncertainty. Inflation followed. And once again, the burden shifted. Over more than a century, the purchasing power of the dollar steadily declined. Not through accident, but through policy. Small percentages compounded over generations. Meanwhile, financial institutions adapted. They grew. They merged. They remained essential to the system, and protected by it. The meeting in 1910 didn't create greed. It didn't invent inequality. But it shaped a framework where financial influence could operate with remarkable durability. A system built quietly, maintained carefully, rarely questioned in full. Today, most people experience it only indirectly, through prices, interest rates, wages, and debt. Few know how it began. Fewer still understand why it was designed the way it was. History doesn't always announce itself with noise. Sometimes it moves quietly, behind closed doors, while the world looks elsewhere. What happened on that island over a century ago wasn't just a moment in time. It was a turning point, one whose effects continued to ripple through every transaction, every crisis, every recovery. Understanding that moment doesn't change the system overnight, but it changes how you see it. And once you see it clearly, you start asking different questions about money, power, and who truly benefits when the system shifts. If you want to keep exploring how financial history shapes the present, stay with this channel. Because the past isn't just did it, it's embedded in the structure of the world you live in now. At Finance Matters, we explore history, economics, and perspective without hype or speculation. If this video added value, subscribe to the channel, and press the bell icon to receive future educational releases. Your support helps keep this content independent and informative.